As part of the 2023 budget, the federal government proposed a change to the criminal code to cap the maximum interest rate on loans at 35%. That's down from 47%. Now, the goal of these changes, they said, is to protect non-prime borrowers, people whose credit scores aren't high enough to get loans at most banks. But some experts worry that this move could actually lead to hundreds of thousands of borrowers losing access to credit while driving other borrowers right into the arms of payday lenders. For more this morning, we're joined by Mike Moffat, Assistant Professor of Finance at Ivy Business School. Good morning, Mike.
Good morning.
So the news of these potential changes is going out to borrowers via a letter from their non-prime lenders. What happens to the credit they already have access to?
So nothing changes there. So if you've signed a contract with an existing set of rules, that stays in place. But once this becomes enacted, that any future loan that you would get would be at 35% interest rate or less. There's some changes here to payday loans as well. And what the federal government is trying to do is basically save money for low-income Canadians who often rely on these loans, having them pay lower rates of interest.
So once this goes into effect, who does it help and who gets hurt?
Well, it should help most low-income borrowers because they would be getting lower interest rates. The risk here is what the Canadian Lenders Association is talking about. They're saying, well, look, there are a number of borrowers who it simply isn't profitable for us to lend at 35%. So in that case, they might not be able to access this credit and have to go to, more shady operations that are less regulated and where borrowers may even have to pay higher interest rates.
Yeah, and those are the concerns that you just outlined there, that people who have poor credit will go to these short duration loans or payday loans as we know them as. Why make this move in the first place?
Well, I think Canadians are hurting because of higher interest rates. That obviously it's hurting middle-class families on mortgages and the general cost of living. But those at the bottom are getting hurt the most. So absolutely, I think government has an important role to play into protecting low-income and vulnerable consumers. Again, we just need to make sure that there aren't too many unintended consequences from this move.
Yeah, what concerns you most when you take a look at this?
Well, I think the biggest one is just making sure that Canadians are protected, that these loans are still viable at 35%. So I think overall, I think this is a beneficial move. I just think we need to make sure that we study this and that we're not going to see lots of consumers fall between the cracks here.
It's an important issue to take a close look at. Mike, thank you.
No, thank you for having me.
Hey, thanks for watching. If you liked this, be sure to subscribe here, or you can check out more Your Morning videos right here.